Silver's not $35. It's not 50. They lost. And, they're going to be trampled if they try to get in the way, especially if you go back. If you push gold back up above that 5,300 again on a close, it won't stop this time. Silver will ramp. And that's when you'll see the bigger portion of the move in silver than what we saw from November through January. Seemed like a lot, but on a ratio basis, hardly even reflected the dimension of the prior range. So anyway, I think we're sitting on dynamite there, and I think it'll unfold largely early to midsummer. Anyway, that's our view right now, is that the metals are basing. We suspect by the end of this month, you'll see much more evidence of that, and by next month, probably new highs.
Precious metals appear to be forming a powerful base as market momentum shifts toward a potential breakout. According to momentum analyst Michael Oliver, gold reclaiming the $5,300 level could trigger a sustained rally rather than another short-term spike. Silver may outperform dramatically, with price expansion expected to exceed the gains seen between November and January. Historically, silver accelerates once gold confirms strength, and current ratios suggest the larger move is still ahead. If the base continues to build through the end of the month, momentum signals indicate new highs could emerge by early summer, positioning gold and silver for a significant bullish phase in the metals market. Now, we present the clips from Michael Oliver's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Silver and silver miners. In other words, of the two metals, I'd buy silver. Okay. Of the two mining categories, gold miners or silver miners, I'd buy silver miners. This is a technical statement. Silver broke out versus gold on a relative performance basis. And despite the sharp pullback at the end of January, that spread did not break down. In other words, the relative performance breakout we had in November has not been negated, okay? And then when we look at silver miners and plot them in relation to gold miners on a relative performance basis, again, a spread chart, they've broken out. In fact, they broke out like a couple quarters ago. And sure enough, they've done better than the gold miners on a relative gain basis. And so those two factors echo each other. They're saying silver miners. So it's not just silver versus gold, it's their miners, which are vastly underpriced, if you look historically, to the gold miners. They're very cheap in relation to. And so is silver still very cheap in relation to gold. So I think both of them have a lot more to go, not just in net price, but in the relative valuation to gold. Well, the dollar decays, the quantity of dollars, M2, for example, basically increases 80 to 90% every 10 years. What a worthless piece of paper. I mean, I've said it probably on your show before, but your granddad built a house for $4,500, your father for $45,000, and now if you want a median priced home, it's $450,000. Is that because houses are going up in value? No, it's because the money unit's collapsing continually. And so when the Fed panics over issues like their government paper not being perceived to be stable, and they print to save their bonds, or they print to help financial sector because they realize that's the one they got to really protect, even though it's not a mandate. They print money. They cut rates, then they print money, and it gives them an excuse to even push further on the pedal. And the Japanese are doing it. In fact, the new prime minister over there was elected, a year ago or so. She claimed to be sort of like a replica of Trump, intellectually speaking. And she used the phrase print, print, print. That's what she's going to do to defend those bonds. Well, I mean, that's like, that's hardly what you call a free market point of view. That means the money unit's going to be destroyed by the government just to protect their paper, okay, which doesn't ultimately work. But ultimately, it does do something. It drives up real money, gold and silver. If you think about this another way too, silver was capped for 50 years at $50, with lows down around $4 or $5. Okay. So dimensionality there of $45. If you take that dimension and add it to the high, which is 50, you come up with a swing target of 95. If you go back and you'll notice on the way up to 120, there was a fighting effort in mid-90s. Some people said, hey, we've reached the swing objective. And they tried to top it and it didn't work. Blew up to 120, okay? So meaning that didn't work. But if you take that ratio between the lows of that 50-year range and the high, that's a tenfold range in dimensionality. Tenfold times 50 is what, okay? You get the point. Also, if you factor in the decay of the money unit, M2, how much has it increased since 1980? You can do your own homework on this. Or since 2011 even, when we were at $50 the second time. That would project silver like 250 to 500, just to get even with its real dollar value. And also when you look at things like copper and lead, they had a range like silver had for decades. Silver stayed in its range up till just recently. They broke out in 2006, 2005 for copper and 2007 for lead. And what did they do in the couple quarters after that? Quadrupled in price and then lived in a new reality. How come silver wasn't able to do that? Gold made new highs each time it made a bull move. Eightfold gain, constantly blowing out the prior high, but silver wasn't allowed to. Well, whoever tried to restrain that didn't succeed. Okay. And so there's still chatter about, oh, golly, they're manipulating the market. Yeah, they may be, but are they winning? No. Silver's not $35. It's not 50. They lost. And, they're going to be trampled if they try to get in the way, especially if you go back. If you push gold back up above that 5,300 again on a close, it won't stop this time. Silver will ramp. And that's when you'll see the bigger portion of the move in silver than what we saw from November through January. Seemed like a lot, but on a ratio basis, hardly even reflected the dimension of the prior range. So anyway, I think we're sitting on dynamite there, and I think it'll unfold largely by early to midsummer.
Silver is showing powerful bullish signals compared to gold, with a strong relative performance breakout that began in November and remains intact despite recent pullbacks. Technical analysis shows silver and silver mining stocks outperforming gold and gold miners, highlighting a major shift in the precious metals market. Historically undervalued, silver miners are trading at extremely cheap levels relative to gold miners, creating a potential explosive upside. As global money supply expands and fiat currencies lose purchasing power, real assets like silver are gaining momentum. Analysts suggest silver could eventually target $250, $500 when adjusted for inflation and monetary expansion, making it one of the most compelling investment opportunities ahead. Let's get back to the interview.
I think J.P. Morgan and also another major bank, I'm not sure, it may have been Morgan Stanley, projected gold reaching a level we've mentioned a year or so ago. That's 8,000 plus. And the rationale for that, and I'll repeat it, I've probably said it on your show before, it is nothing but a replication of the two prior bull moves in gold. They were both eightfold dimension. Bear low, bull high, bear low to bull high, 8 times gain from the low. Well, our low was what? 1,050. You do the math. Okay. Now suddenly JP Morgan comes up with a number of 9,200 or something as a target based on some fundamental analysis they did. Fine. But it's interesting to hear that now, a year after we've been saying, hey, that's no big deal to even go 8,000. We've done it twice before. Eightfold move. And consider the background that we're living in, the fundamentals that are underway, government debt problems. That wasn't the issue in 2007 to 9. It was mortgages. Now we got government debt being questionable. Okay. Long-term debt. Whoa. I mean, that's a major asset category. It's bigger than the stock market. It used to be an alternative to the stock market. If the stock market was in trouble, you could buy bonds. In fact, that worked. 2007 to 9, stock market imploded, bonds went up. So did gold during that time. 2000 to 2002, stock market got cut in half. NASDAQ dropped 80%. Gold went up during that time. Bonds went up during that time. Right now, bonds are suddenly, not so sure they're going up. Yields might, but the prices isn't. So what does that leave you with? One alternative. And it's never the case in history that when you have an asset class implosion like that everything goes down. Yeah, there might be a moment here or there where gold goes down with the stock market, but basically its trend will be opposite a stock market bear. And so if all of a sudden you don't even have T-bonds as an alternative, wow, you have a vacuum. And anybody who is continually calling for tops in gold and silver, it's a continual process. And every time they do, and I'd have never seen a bull market top in gold where everybody screamed it was a top. Okay. In fact, in 2012, when we put out we called the top in the gold market, we said it's over. We hit 1920 and we dropped into January of 2012 and we said that was it. It's over. Only 2 months off the high or so. Over the next year, gold went sideways, but never got back to the high. And we had complaining subscribers. We had to write a report called Open Letter to the Gold Bulls. Okay. Explaining to them, sorry, we know you love it. It's good in the long term, but it's going down. And we gave them the technical reason. Right now, we have 0 technical long-term reasons to assume gold has made a top. or silver. So it's a totally different situation, yet everybody's crying it's over. They've been saying it all the way up, not with silver, but with gold. Every time gold makes a high, a prominent high, it usually will plateau for quite a few months. Look, go back to April, May, June, July. It took like 5 months for it to get up out of that range it was at. And every time we do, everybody who calls for a correction thinks it's going to go back to the high end of the prior range. And if you go back and look, it doesn't do that. It hasn't done that. It's had drops, but it never goes back to the orthodox level where people say, that was old resistance, it's now support. So they're using a rationale that isn't working. And we have the same thing going on right now. Silver's going to go back to 50. That's the top. Well, anything could happen, I guess. But our work says no. It says you better be prepared, because if you don't break this market real soon, further than what we saw on the first trading day of February, basically you could circle it on all these, the miners, on gold, on silver, just circle that. And look where you are now compared to that. You better go take that low out soon, or you better think a different way. This is not a normal bull market. So the orthodoxies of, it's overbought. Yeah, in a normal situation, yes, it is. But that doesn't mean this is a normal situation. And therefore, you can get overbought and stay overbought longer than you might think, in which case you missed the move. Okay. So anyway, that's our assessment right now. We think that we're not issuing any long-term buys, and the reason is we issued 3 over the last year or so. One was in April, May, June of 2025. Gold was coming up back toward 35 again. We issued one in early 24 when it was coming up through 25 to 26. That was a major buy for us. We knew it was going to blow out the 25 level, which it finally did, and it zoomed into the 30s. Then it congested for a whole year with tops at 35. We had a pullback into April last year, started moving back up. When we started to move back toward those old dual highs at 35 plus, we said, this time it's different. It's going to blow through. It's going to accelerate. That was our second major buy. Our third and final major buy, based on long-term metrics, was the November close. That's when silver broke out versus gold. We're not going to offer any more buys. In other words, if you're buying now or later, you're on your own. Yes, you're probably going to make money, but it's not an optimal point of entry. And that's what we try to offer.
Gold may be entering the most powerful phase of its long-term bull market. Analysts note that the previous 2 gold bull cycles delivered roughly 8-fold gains from bear market lows. With the last major low near $1,050, a similar move suggests a potential target above $8,000 per ounce, a projection now echoed by major banks like JP Morgan, which recently suggested levels near $9,000. The difference today is the scale of global debt and instability in government bonds. If bonds lose their role as a safe haven, investors could rush toward real assets like gold and silver, accelerating the precious metals rally even further. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.